All right, what's up, guys? Happy Thursday. I hope you're all doing well. Hope we're all holding up here in this crazy market. But good to be here, guys. So we'll recap today's session, kind of take a look at a few things here. I promise not to keep you too long, but we do got a bit I want to discuss here. Now, before we jump in, though, this is a good market to be really careful about. Call it your attachments, right? You got to be careful about having attachments specifically to your P&L in this market. And a lot of you know I'm short right now, so I'm short the IWM, short a few different things. So what I mean by attachments is the market gaps down this morning. In this particular account was up like $10,000 at the open. So I'm up 10,000 at the open. At the end of the day, you get the huge bounce here. This account finishes a day down like 2K. So pretty big shift there in P&L. Those aren't the things you want to pay too much attention to. We want to be really careful about letting our emotions, our mood, and our decision making. We don't want to like link that up to our open P&L. In other words, what I'm trying to say is, we got a volatile market. The short covering bounces are going to be huge. The flushes are going to be nasty. Make sure you're focusing on structure over your P&L. Otherwise, you come into a day like today, you're short, you're having a hell of a morning, and then come late afternoon, it all goes against you. So if you start to make decisions based on emotions, next thing you know, you're getting out of shorts that you shouldn't get out of. You're buying calls on things you should never buy calls on. You just start making you start making decisions based on emotion. So I think it's important to keep that in mind in these volatile markets here. But we'll dive in, guys. So big gap down this morning. We got the headlines with Russia, Ukraine, all that craziness. So a big gap down at the open. And then we get the pretty big short covering rally into the end of the day. And the short covering rally puts us back above the January low. And tonight, into tomorrow, into the weekend, into next week, the January low is going to be a really key level. You can see we blow right through pretty much like it doesn't exist this morning. But then we finish the day back above that previous level of support. Very much the same thing here for the QQQs. We blow through the January low earlier, but we close back above it. So that's a key level to focus on, guys. In my opinion, if we lose that level, so for conversation's sake, if we open up tomorrow after such a big short covering bounce, if we're right back under the January low, I think things get pretty ugly to the downside into the weekend. So the bulls, they got a pretty clear level to defend here. Now, if the grind continues, because keep in mind, right, there's two questions we want to ask ourselves when we get these big bounces, especially if you're short. But two important questions you got to ask. And the first thing you want to ask yourself is, has anything changed? And what I mean by that is, I'm shorting the market right now for a few different reasons. You have the loss of momentum on the monthly squeeze, the loss of structure on the monthly chart. There's weekly squeezes that are just starting to get going. So from monthly charts down to bearish weekly squeezes down to daily sell signals, these are all my reasons for wanting to short the market. Total shift of trend, structure, momentum from a monthly chart down to a weekly chart down to a daily chart. So that's the first question we got to ask ourselves, because believe me, if we do continue to trend lower into March and into April, I can promise you along the way, as we go from point A to point B, wherever point B is at, you're going to see plenty of action like today. Market gaps down, everybody buys puts, and then everybody who buys puts this morning just totally gets crushed. So there's going to be a lot of really big bounces, even if the path of least resistance continues to be to the downside. So the first question we got to ask ourselves on a day like today, has anything changed? More specifically, has the structure changed? If you're short this market and you see a bounce like today, did any of the reasons that got you short in the first place change? So for the QQQ here, Nothing changes at all today. We're under the daily moving averages. There's negatively stacked EMAs. We're under the weekly moving averages. Okay? So nothing changes there. It's certainly still bearish. Big bounce out of the S&P, but you still have a bearish weekly squeeze. You're still under weekly moving averages, and you still have a bearish daily squeeze. So structure doesn't change there. Structure doesn't change on the Qs. And structure doesn't change on the IWM either. You have sell signals. You're under daily moving averages. You're under weekly moving averages. And then if we go sector to sector, nice bounce today for the semiconductors, but they still have sell signals. Still a bearish structure. Nice bounce out of XLK, still bearish. Healthcare sector still has a sell signal. The industrial sector still has a sell signal. Basically everything out here still has bearish structure, even after a pretty impressive bounce. So that's question number one. Has anything changed as of where we go into today's close? Nothing changes. Like they didn't fix any of the problems on the daily charts, the weekly, etc. So that's question number one. Question number two is, okay, we got a strong bounce today. And so long as the structure is still bearish, are we bouncing enough for me to do anything with it? Is this a big enough of a bounce for me to put on a short position? And for the indexes and the sectors and a big majority, right, a vast majority of the things out there, from my perspective, today's bounce was not enough to warrant me wanting to jump into a new short position. And I think the easiest way to get a good sense of this and get a good grip of it is look at the inverse charts. So if you look at the minus QQQ, if this is what the Qs look like, and there's positively stacked EMAs, there's green 10x bars, there's a bullish daily squeeze. Ideally, we would love to buy this at the 21 EMA. We're probably not going to be in a huge rush to buy it up here just yet. It's a little extended. But if we could get an entry at the 21 EMA, for a lot of us, that's a dip that we would love to buy. And we would buy the dip because of the structure. So take the real QQQ as it currently sits. We want to short this because of structure. I'd much rather do it at the 21 EMA. So the Qs bounce. I mean, you bounced more than 3% because we were down 3%, but the Qs finished the day up 3%. Still not a good short just yet. If you look at the inverse of the S&P 500, there's a stacked EMA, there's green 10x bars. I'd want to buy the dip, but today's dip isn't enough. It's not where I want to get long. I want to get long at the 21 EMA. I want to take profits on that big push. So if the current structure says short it, today's bounce is a good start, but I want to short it at the 21 EMA. If we're looking to short Microsoft, the sell signals tell us it's a good short, but notice how this gets a little bit closer. So I think right now, guys, big picture structure to me is still bearish. So the question tomorrow, the question into next week is, do they continue to squeeze the shorts? And does that result in a big enough of a bounce here to start to offer up some good entries on new short positions? And a lot of you here tonight just did the class. The class we did a few weeks ago. Look at the trades that we did in the class, because these are the entries we're looking for. So we short Nike because of the structure, but we short Nike up here at the 21. Then you can take profits on that flush. So that's what we're looking for. We have plenty of bearish structure. Almost everything out there has a sell signal, so there's plenty of things we could short. We just need better entries. So Nike, to me, that's textbook. Find a daily squeeze with some negatively stacked EMAs, a negative histogram, short it at the 21, take profits on the flush. We took profits yesterday on Comcast, but look at the entry, right near the 21 EMA. So that push off the 21, you're fully maximizing on that. You're benefiting from that whole push. So we closed profits on Nike and Comcast. We took profits this morning in Uber. Look where we're getting short. So for the next couple of days here, y'all, that's what I would be on the lookout for. Does this bounce turn into a bit more? And do we get an S&P 500 back up towards the 21 EMA? I want to short it there. Could we get the QQQ back up towards the 21? I'd like to short it there. I might jump back into something like Nike. I'd have no problem in shorting Comcast back at the 21. I think Adobe's getting pretty close. So if you look at the inverse of Adobe, hell yeah, I want to buy the dip here. Bullish daily squeeze, positively stacked EMAs, green 10x bars that just want to get it at the 21. So we got to take our current structure and now work the patience side of things to wait for some better entries. So today's bounce, not only did it not change the structure of the indexes, it didn't bounce enough to give us a great entry on a new short position. So that, my friends, is a focus here into tomorrow and into the rest of the week. If we get a nice rip here, and you got your S&P into the 21, the Qs, Adobe, the list goes on and on, I'll look to put on new short positions. If we don't get that big bounce, I'll continue to hang on tight to what we currently have here. But those two questions, has anything changed? And can I do anything with it? I think that's going to be really helpful as we continue to try to take this market lower and lower. Going to have plenty of days where we gap down 2%, your short positions are kicking ass, and then come lunchtime, there's a total flip and we're up 2%. If the structure is still bearish, so work off the checklist. If the structure is still bearish, you kind of look at the S&P 500 and say, bring it on. If you're going to bounce here, let's get a real bounce. That way I can short you. So that's a game plan I'm working here, guys. For open positions, I got the IWM short. Got a short on Apple in the options room. And we'll see what tomorrow brings. That is your key level. So you best believe I'll be watching the futures here tonight. This is just such a huge, today's move is very impressive. You got to give the bulls credit after a shift like today. You go from down 2 to almost plus 2. After a day like today, if they lose that key level tomorrow, I think just as quick as we ripped higher today, we're right back at that low. Is understand that dynamic. We're in a market here where we can go up 1 to 2% like it's nothing, and then just completely turn around and go down 1 to 2%. So the intraday, the Monday through Friday, it's packed with all kinds of volatility, and it's packed with all kinds of just, massive intraday range. Where I'm getting the clarity from right now are the weekly charts. Got a lot of back and forth this week, a lot of herky-jerky. It doesn't change a damn thing about the structure of this weekly squeeze. As long as this sucker has no stacked EMAs, a histogram getting increasingly negative, and we're under the 21 EMA, it's a short in my book. So today's bounce doesn't even get on the radar in terms of potentially shifting that structure. We're not back above the 21. We don't have stacked EMAs. That weekly squeeze, in my opinion, is still getting ready to release all that energy to the downside. Today's bounce in the QQQ, again, as impressive as it is, well, you still got a weekly squeeze firing short with no stacked EMAs under the moving average. So as long as the weekly chart continues to print that picture, your S&P, your QQQ, and your IWM are in weekly squeezes under the moving averages, negative momentum. As long as that's a picture that's getting painted on the weekly chart, going to continue to want to short any legit bounce. Today's bounce, not legit enough. But no dull moments, guys. So going back to what I was saying earlier, right? Structure over everything. Very tough market here where if you're going to focus on the open P&L, here's a market we're in if you're going to focus on open P&L. At the open, you got maximum euphoria. So imagine my position this morning. I'm short the IWM. So here we are at key support, right? This thing breaks, I'm going to be up XYZ. I'm short Apple. That's dumping this morning. If you start pumping on euphoria, what happens when it all shifts? Well, if you got maximum euphoria on Apple at the low of the day, you're just putting yourself in a position to have all kinds of stress and anxiety at the high of the day. Way more important here is the structure, none of which changed today. And guys, that's all I got for you now. I'm watching names like Adobe, watching a few individual stocks here. And granted, we had good shorts on Nike and Comcast, on Uber, but it all comes back here to the indexes. So while I think Adobe is a good short, if the S&P and the Qs rally for the next 5 sessions, this is most likely going to trade much higher. So is it a bearish structure? Certainly. Is it a good short at the 21 EMA? For sure. But if the markets keep pumping here, this is going to keep pumping as well. So, run your scans, build your watch list, have your names ready, but then just kind of have the realization it all comes back to the market. If you're short anything right now, it's probably going to make you a lot of money tomorrow if the S&P breaks January support. At the same time, if you're short anything right now and this market continues to grind higher tomorrow, whatever you're short is probably going to pop. So it always comes back to Big Mama S&P. But there you have it, y'all. We'll take it from the top to the bottom here. Monthly squeezes have lost momentum, and we're trading under the monthly AEMA. That's a big time shift of structure and momentum on your biggest time frame. We have weekly squeezes that are bearish, no stacked DMAs, under moving averages, negative histograms. First negative histogram on the weekly chart since the COVID flush. On top of that, we still have daily charts spitting out nothing but sell signals. Where this all changes for me is if on a weekly basis, the indexes are back above that weekly 21 EMA. So I basically want to short any bounce to the extent we're under the 21. To me, that's where structure starts to change. Until it doesn't, we're looking for good shorts here. So we'll see what tomorrow brings, y'all. If you got any questions, anything you want to take a look at, more than happy to hang out for a bit here, answer as many as I can. But I mean, quite frankly, guys, it's a pretty straightforward market. Focus on the indexes. If you're trying to get short, try to do it at a good spot. A good spot is typically after a really strong push versus getting short down here this morning. So we'll see what tonight brings, but there's your level. Personally, I would expect some nasty to the downside tomorrow if we give back that January low tonight and into the open. So for the S&P futures, if you want to watch that, that's basically 4,400. I'm sorry, 4,200. Yeah, so if the S&P futures are trading under 4,200 tomorrow, hell, I think we could take out today's low. That's the kind of market we're in. So if you lose that key level, I think things get nasty. So tonight, keep an eye on 4,200 here on the S&P futures, and for the SPY, that level would be 420. So 420, 4,200 for the S&Ps. That's the big level for the bulls to hold. And if they hold it, I think we get better short entries. So it's an important spot here. If we break it, whatever we're currently short probably brings back some money. If we hold above it, we can probably short a few more things at much better prices. So 420/4,200 for the S&P. For the NQ futures here, that level is going to be about 13,700. And on your QQQ, that lines up at about, say, 335. 335, 334. It's the January 24th low. So take January 24th, mark up the low for the S&P, mark up the low for the Qs and for the IWM. There's your key level into the weekend. But that's what I got for you guys. Let me poke my head in the chat here, see if we got any questions. But while there's a lot we could probably jump into and do a deep dive on, I think we want to keep a focus on just the bigger picture stuff here. And the most important of the bigger picture stuff I'm seeing are these weekly squeezes. I think we got way more downside to come unless everything completely fixes itself here. But to me, that's the number one time frame, the weekly chart. So we'll see how it all unfolds tonight, guys. Let me see. Futures should open up in about 40 minutes. So I shall be watching tonight. How crazy is that, though, right? The Qs finish a day up 3%. Your Qs finish a day up 3%. And what do we get out of it? A little pop to the 8 EMA. So the previous day was pretty ugly. If a 3% finish can't get you out of that range. But that's what I got, gang. We jump in the chat here, answer some questions. We'll keep S&Ps up here. But I think you got potential on both sides. It's not a very kind market. So it's all kind of a matter of who do they want to hurt tomorrow. I could easily see that low breaking, and tomorrow is just painful for anybody who bought calls here today. I could also see the short squeeze continuing. So I think it's all going to be dictated based on whether we're above or below the January low. All right, let me get caught up in the chat here, see what y'all got going on today. What's up, Mimi? Sorry about that. Yeah, Spacewalker, it'll be interesting. It'll be interesting. I mean, just I think for the sake of self-respect, I don't think I can. I mean, who am I? None of us have any clue. Suppose my thinking would be just for any sense of self-respect, the Fed would at the very least stick to their guns with the rate hike in March. But listen, there's a whole dynamic at play right now. They might get backed into a corner. So that's not going to be dull. Yeah, not too much more to say there. I could certainly see that being a big catalyst, though. Yeah, Brad, a good point. At least I certainly haven't traded a European war. So I'm not sure if we got a instruction manual for this kind of market just yet. Big Terry, what's up, homie? I'm with you there, man. I am with you there. Hey, what's up, Josh? Always good to see Josh. I like DraftKings, Josh. It all lines up here for a short. But we got to have the expectation. If the market continues to rally into tomorrow, into Monday, it's probably going to take DraftKings with it. It's the only reason it bounced here today. I don't think you had any news in DraftKings. So it's a good short structurally. But that's where that timing component comes into play. And if you look at my shorts in Comcast, in Nike and Uber, they all worked really well because I'm shorting these individual stocks at the same time the indexes are getting pushed off resistance. So just as the S&P is getting ready to roll over here, we're short in Comcast, we're short in Nike, we're short in Uber. But DraftKings is at the shortable spot. It's right at that sweet spot. Don't have quite the same timing with the market, at least not right now. So to me, it's shortable. I say let's keep an eye on this into tomorrow. It's already at the 21 EMA. Ideally, we get signs of a rollover in the market and then try to short DraftKings here. But I think you got a great one for the watch list. Certified downtrend. And then Josh, TLT for a short. Um, so I know the treasuries they play a bigger role as far as like the macro of it all. Just taking this chart at face value, structure for structure, yeah, Josh, it's a short. Negatively stacked EMAs on the daily and the weekly. So just based on the indicator here, based on the checklist, only thing I could do with it for now would be to short it. Based on structure there. Hey, Kevin, good call out here. Really good call out here in Skyworks. I'll just give you the same advice in that I gave in terms of DraftKings. You got a sell signal. You got negatively stacked DMAs. It all lines up here. And yeah, this is, if we flip this upside down, very bullish, and we essentially want to try to buy every dip to the 21 until it stops working. So we're trying to work that same game plan in a downtrend. So a great call out here. This is where you would ideally want to short it. Just focus on the indexes first. This probably rips a little bit higher if you continue to get a short covering squeeze in the S&Ps, the Qs, etc. I think if we can get to the point where we got some good confirmation, like, okay, they're done squeezing shorts, these indexes look like they're going to roll over and take out the low, then I'd love to short something like Skyworks. It's a tough game, guys, because the upside's a lot different, right? The upside, you find a stock in a trend, and a lot of times you can find individual stocks that just kind of do their own thing. In a market like this, everything tends to flush when the S&P flushes, and everything tends to bounce like a bat out of hell when the S&P bounces. So I think great name here for the watch list. That's just the $1 million question. What does this bad boy in the IWM and the Qs pull out of their hat tomorrow and into next week? But Kevin, a great one for the watch list. Great one for the watch list. So for the Apple short, we can pull that up here. There was a whole lot more profit there this morning, let me tell you. But for Apple, we have a March 18th expiration, 160, 165 call credit spread. That's what we're rocking with there. And we put that on Tuesday. I believe Tuesday. This week's a little bit weird. We put that on Tuesday. So it's a massive world of difference. If you short Apple this morning, and that's all emotional, right? It's like, holy shit, the S&P's down 2%, the Qs are down 3%, Amazon's down 4%. Like, it's so easy to get sucked in thinking you have to short something. If you buy those Apple puts this morning, like, this is just a tough day. It's a really tough day. Like, you're already in the hole pretty good. But if you can short as close to that 21 EMA as possible, today is more of a nuisance than anything. But Amazon rips face here into the close, and we're still sitting on some decent little profits here. Like, granted, that's 10 contracts, so we're up like $40 per contract. But that's the world of difference right there. If you can short near the 21, well, you're in a totally different position on today's bounce. You're operating under, an entirely different set of emotions and mindset versus getting short today, when everything seems very shortable. So that is what we're rocking with there on the Big Apple. Hey, Glenn, great question. So 100%, I would consider adding short to the AEMA. Here's the only thing that would be contingent on is if I'm going to short the Qs, for example, at the AEMA, I'm going to personally do so fully willing to sit through a bounce up to the 21 EMA. Frankly, probably willing to sit through a lot more. But at a bare minimum here, if we flip the Qs upside down, I'd say, Glenn, we can buy this dip today. We got a lot of reasons to buy the dip today, right? So we could buy today's dip, Glenn, but I'd want to make sure we buy it in a fashion so time till expiration, strike selection, choice of strategy, position size. Let's buy it here today at the 8 EMA in a fashion where if this comes in a little bit more to the 21, not only can we hold on comfortably, maybe we can add a bit more. So I think at the 8 EMA, maybe a spot where you take a partial position size. So maybe you're looking to get a 3% position size max on the Qs. I think the 8 EMA is a great spot to grab maybe 1.5%. Then if we puke it up, you're still making money. But then maybe add the second half on any further upside. So yes, certainly look at the 8 EMA as a potential spot to nibble. But what I wouldn't want to do personally is get short here at the Qs in a fashion where a move to the 21 would be super uncomfortable and super painful. So I would almost short at the 8 EMA with the expectation you probably get a little bit more upside. I think a healthy expectation. Hey, what's up, Lucas? Always good to see you on these calls. So Lucas, at the IWM, looking for a flush of that January low. God, we must have ticked it to the penny this morning. 188.09 versus one. Actually broke it a little bit. But Lucas, what I'm looking for is a real break here of that January low. And then on that flush into 180, 175, that's where I take the profits. So I'm kind of looking at that weekly 200 SMA right in that 180, 175 neighborhood. Probably for me going to be the good spot to take the profits. And we can look at it here on the Analyze tab. As soon as this unfreezes on us. But let's see, IWM. Say it's into next Friday, which would be splendid. At 175, 180, that trade I'll be up about. And keep in mind, it's 50 contracts, but at 175, 180, I'd be up about 15 to call it $13 to $15,000. The move into 170 would net another, and again, this is all relative, right? The move into 170 would net maybe another couple thousand bucks. But for me, that's more than enough. If we could drift into that monthly 200, 180-ish, 175, at that point on a trade that could bring in a max profit of 21,000, taking home the 15-ish, the 14-ish, it's a pretty good healthy chunk. And what I would like to do is, because I'm only risking 3,500 here. That's the ugliest it could get is 3,500. So what I would like to do is let's break that low. IWM, if you're listening, let's break that low. Let's get that flush down towards that monthly 200. Let me take my profits to the tune of 14,000, 15,000. Then I'm going to sit on my ass and wait for the next good bounce. So for conversation's sake, say it were to all unfold like this. Break the low, flush to 175. I want to take profits. Then I'm going to wait for the next good bounce. Say we bounce back into 190. Here's what I would do. I'd take another 3,000 of risk and set up a similar trade. Where at some point, I'm going to look for the index to come down and break through that new low. In a perfect world, I'd like to do this 3 to 4 times. So if we could trend lower into March, April, to me, that's how ideally I want to try to get positioned. Take profits on the big flushes, wait for that big bounce, risk a very modest portion of the account and of the profits on the next short. If you can nail that, say 3 times, you're going to have some really, really good account growth. So for the current trade, I would like to take it down to 180, 175, at which point I take the profits, wait for the next bounce, try to rinse and repeat. Basically, doing what we were doing last year for the QQQ in the S&P. Take profits on that big push, wait for that flush, buy the dip, and try to rinse and repeat that pattern until it stops working. It works, it works, it works, it works, it works. Then one day we wake up and it stops working. That's when it's time to shift the game plan. So we'll see how it all unfolds, guys. The good news is we get to go through it all together. Good stuff, Go Fast. Good stuff. Hey, Miss Heather, always good to see you. Yeah, Ryan, good question. Good question in terms of the exits on Nike. So, like Ryan, with Comcast, for example, I got the wrong question up there. So with Comcast, for example, we came into that trade looking for, there we go. For Comcast, we kind of came in looking for a flush under that recent low. And we just about got that yesterday morning. So that kind of gave us the majority of what we were looking for. But for Uber, it kind of comes down this morning, blows through that recent low. So generally speaking, these kind of gave us the moves we're looking for. One suggestion I have is, so say on the IWM, the level that we pick is a target is 170. Here's what you want to pay attention to. So say your target's 170 or 175. Say you got a 175 target. So that's what you identify as, hey, before I jump into the trade, that's where I want to take profits. I'm a firm believer you really want to identify that level before you enter the trade. But here's where I think you allow for some wiggle room. Because I'm trading spreads here. So 175 might be my target. But say I got a credit spread on where my max profit is. Say my profit at 175 is going to be $200 per contract. If I find myself kind of within a stone's throw from the target, and if I hang on, maybe I could only make another $100 or so. In other words, once we start getting close to that neighborhood of the target, I think we want to have a little bit of flexibility in allowing ourselves to just take the money off the table. And that's typically going to vary depending on, did you go deep in the money with your short strikes? Did you give your trade 5 days till expiration or 40 days till expiration? But yeah, I'm a firm believer, don't jump into that trade until you identify that target. But then as that trade develops, give yourself a little bit of wiggle room because, and I've done this time and time again, I'll set something up on the IWM. My target will be 185, call it. I'll get so close to 185, I'll maybe have another couple $100 to make. It's like you wait for it, you wait for it, you wait for that last inch, and then everything reverses on you. And what that does is it puts ourselves in a position where now we have huge lost opportunity costs. So Comcast might be a good example of it. What you got to keep in mind is you're going to reach that point where there's a decision to be made. So say you're trying to take Comcast into, to make the discussion easy, say our target here was $44. This morning you get within 27 cents. And this is a human nature thing. And I've gotten myself in plenty of trouble doing this in the past. Human nature will want to have you hanging on for that little bit of extra profit, right? That little fulfillment of taking that exit exactly to the T where you wanted to take it. But as our trades develop, we want to think of what's our current risk versus reward. Because there's the risk versus reward when you open the trade, but then there's the risk versus reward of that position as the position starts to develop. So here's what I used to do a lot. My trade would be working. I'd be super close to my target. And for conversation's sake, let's say I'd be in a situation like this. I'd sell a spread that has a max loss of $2,000. Maybe it's got a max profit of $2,000. And time again, I'd find myself in a position where the open profit would be something like $1,800. So in other words, it's right there. It's right towards my target. It's given me almost everything it can give me. But for a lot of us, myself included, there's that human nature kicking in. It's like, no, I want my extra $2. If I said I'm getting out at 44 bucks and a quarter is not good enough. Here's the massive risk in that. Think of your current risk reward. You're up $1,800 on a trade that could only make you $2,000, but you initially have a risk of $2,000 on. So at that point in time, consider your new risk versus reward is you're risking your $1,800 of open profit and your original $2,000 of profit. So you're risking a $3,800 swing, all to make an additional $200. So from that perspective, when we get really close to that target, just understand you might be in a position where your decision to hang on for that little bit of extra might mean you're now risking $3,800 to bring home an additional $2,000. You're risking all your open profit. You're risking all your original risk for that extra couple $100. So we at least got to be conscious of this, and we at least got to ask ourselves, would I ever enter a trade where I'm risking almost $4,000 to make $200? Very, very few of us would be comfortable taking that trade. So understand, as the trade progresses, you actually find yourself in that position. You're close to your target. You got a little bit more money to make. But in this market, all that open profit and all your original risk, it could come at you pretty quick. So really good question there, Ryan. And this is one of the things that when I look back on the class, because you go back and you look at slides and it's like, is the dude putting the slides together, I always kind of find a few spots I wish I kind of clarified on. We should have spent some time in the class talking about this. If we short Comcast and we say, hey, 44 is the target, if we get to 44.50, let's just take the profits. Because the extra $200 here in this scenario, it's not going to be a life changer. In all things being relative, whether it's 2,000, 20,000, that little bit of extra that we typically find ourselves holding on for, very, very rarely or almost never is going to be a life changer. Now, what can be a total nuisance is you nailed a great entry, you caught a great move, you're moving the account forward, you've got open profits, but then you all let it come back against you. It's just lost opportunity cost. One of the better questions I've gotten today, Ryan. Hopefully that makes sense, but awesome question, man. Awesome question. So, Sean, the stacked DMAs label, and I'll write this out for you, and you can jot this down. So when there's positively stacked DMAs, here's what that means. It means the 8-period EMA is on top of the 21 EMA, which is on top of the 34, which is on top of the 55, which is on top of the 89. Now, John used to talk about this for years, and I completely ignored it. I was like, dude, what are you talking about? Like, stacked moving averages? Like, what are you getting on about here, man? To me, it's one of the most important parts of my trading. If I'm going to short something, ideally I have negatively stacked EMAs. So that means that my 8 is under my 21, under my 34, under my 55. To me, the stacked EMAs is like my backbone indicator. Right? It's my foundation. It's the core. So right now, Comcast has a bearish core. Right? It's got a bearish foundation because the EMAs are stacked negatively. Something like the volatility. something like the volatility index with positively stacked DMAs, this has a bullish backbone, right? It's got a good foundation. Stacked DMAs means path of least resistance tends to be to the upside. So what John teaches and what I finally learned the hard way over the years is if you're trying to buy a daily squeeze, ideally you're only getting long daily squeezes that have positively stacked DMAs. So your 8 is on top of your 21, on top of the 34, the 55, the 89. And ideally, if we're going to short something, it's the opposite. The EMAs are stacked negatively. That's what that all entails, my friend. Fremont, is Amazon a short? It all comes back to the QQQ. Now, structurally here, this weekly squeeze is finally trying to fire. So we've been in a weekly squeeze since like October of 2020. It's finally trying to fire short here. So yes, I think Amazon's a short, but this continues to bounce to the extent the QQQ continues to bounce. And I can almost with certainty tell you if the Qs break that recent low that we put in a few hours ago, Amazon very much does the same thing. So Amazon's a short, but your next 24 hours, next 48 hours of trading, where it goes is very much dependent on the indexes here. But structurally, Amazon can get hit with that short just like the rest of them. Impressive reversal candle today, though. Let's give it credit where it's due. Pretty impressive stuff there. And Glenn, if I had to go out on a limb, it may be I'm biased, maybe I'm talking my book. I don't think we get back to the daily 21 EMA either. I could be dead wrong there, but it'd be a great shorting opportunity, but I'd be very impressed. I think I'm with you on that one. Hey, what's up, Marty? Yeah, Marty, I mean, I think today's price action, I think today's candles could be very telling. This is the kind of candle, if we just understand like what's going on here, how do we end up with a candle like today? It's a great question. So here's how it all strikes me. Based on today's finish, the door is certainly wide open. If they want to continue to squeeze the shorts and run the market higher, like it's all lining up. So you got open invitation here with today's candle to continue to squeeze the shorts and push the market higher. That would probably be the more likely outcome just based on today's candle's action. It also leads me to believe, like, wow, if we put in that kind of reversal candle today, and then tonight and tomorrow, we come take out that previous low again, that's really bearish. So today's candle, in a general sense, would typically be viewed as bullish. And it should be viewed as bullish. It doesn't change the structure of the market, but typically it's going to set your market up for a bit more upside. So that would typically be the expectation. With that being said, if this goes right back under that 14, that 4,200, I think look out below. It's like the bulls did everything they had to do today to try to take control of the steering wheel. And if they lose it just like that, I think it could get ugly. So good question, Marty. I think 100% something to pay attention to. I think whether you're bullish or bearish as well. Certainly want to keep an eye on those. Mind's Eye Manifestation, is this actually live? You better believe it. Live and direct, 5:50 p.m. Central. Always live, you know it. Okay, Win, awesome question here. And we'll wrap it up in a few, guys. Win, if you can, catch me in the options room tomorrow if you're going to be there. But good question. So a lot of my trading from last year was taking advantage of the trend. It's the same thing I'm trying to do now. Right? And granted, it's all a little bit early, but there's just signs that the trend might be to the downside. So we're trying to short bounces. Right? It's a lot of the same execution. But a lot of what I did last year was wait for a dip, sell a deep out the money put credit spread, and then take profit as the market continues to rally higher. Very high probability trading, very safe trading, but not the best bang for my buck. So here's what's interesting. Trading the way that I traded the spreads last year, like this current IWM short, this could net me about, call it $15,000 to $20,000. With how I traded my spreads last year, to put myself in a position where a trade could net a $15,000, $20,000 profit, I'd have to put up 40, 50, 60,000 of risk. Because I was going with the higher probability spreads, selling the out the money options, risking 3 to make 1, risking 4 to make 1. What I'm doing this year is completely flipping that risk reward. Now, the easy short here on the IWM, if I was looking for the easy high probability short a few weeks ago, would have been to do something like sell the 220 calls. Sell the out the money call credit spread. It's a higher probability trade. We don't even need the IWM to roll over here. Just stay under 220 and we're in good shape. High probability trade, but there's no free lunch on Wall Street. So that might be a trade where, hey, there's just a really good chance this works in our favor. Whether this goes higher, whether this goes lower or sideways. But the risk versus reward is going to be a reflection of that. We might have to put up $4,000 of risk to make $1,000, to make $2,000. Now, the way I did this short, it's a much different set of circumstances. I'm selling those 185 calls, but I'm selling those calls when they're deep in the money. I'm putting that trade on, we're back up here at like 208. So what's the major difference now? With the trade that I have now, it becomes a lot more directional. If I sell calls at 220, all I care about is whether or not, the only thing I need is for the IWM to stay under 220. I don't actually have to be correct on my thinking that we're going to trade lower. I don't actually need the setup to work. The way I'm going about things this year, most likely forever, is very different now. Now I'm selling the 185 call. So now I need the IWM to move in my favor. The difference is the risk versus a reward. Instead of putting up 20, 30, 40,000 to make that $10,000, $15,000 profit, now I'm only putting up 3. So we're trying to marry two things here. We're trying to get phenomenal risk reward out of the option strategy, and it's phenomenal risk reward because it's not high probability. You risk 3 to make almost 20. It's not a high probability options trade. Where I'm trying to get the high probability outcome from is from the setup. In other words, I'm just having more faith in my setup. I got a weekly squeeze. I got daily sell signals. I think this is going to trade lower. So let me put myself in a position where if I'm wrong and this thing just goes back to all-time highs, the pain's going to be minimal. But if I'm right and this setup works, I can risk 3.5% here to potentially make 10, 15, 20. So the trades might not work as often as the deep out the money spreads will, but a much better risk versus reward. I don't have to be correct as often, but when I am, it's going to be very meaningful. So those are the major differences, Win. Those are the major differences. And by the way, Win, I think I saw an email from you earlier. If that was from you, I'll get back to you tonight. Got a lot of emails to get back to tonight. But Win, if that was you in regards to all that going on in the options room. I've got no freaking clue. But you and I can talk about that later. France just surrendered. Shall be interesting. Shall be interesting. All right, guys. One last question here. Sean, so the stack DMAs label, it's not a free indicator. Again, I'm kind of giving you the cheat code here. If you want on one chart, just throw on the 8 EMA, a 21, a 34, a 55, and an 89, and then kind of go about it visually. But to my knowledge right now, I think it's only available through the simpler website. But let me touch bases with everybody and see if that's still the case here. Kevin. All right, guys. Last question of the day here, Kev. What would be the pros and cons of buying an at-the-money put at 220 on the IWM? So, Kevin, are you saying if we could actually get the entry at 220? I tell you what, man, you have way more pros than cons, I think, if you could get a short entry at 220. That'd be a pretty big rip. So I don't see any downsides to that. Generally speaking, right, the only downside to buying a call, at the money or especially out the money, is just the premium decay, which can always be a bummer. You buy it at the money put on the IWM on Monday. A week and a half later, it's trading in the same exact spot. It still looks bearish, like everything is still lined up. But because you haven't caught in the flush yet, your put is down 50, 60%. So that's the only thing to be mindful of. But the one last thing I'll add here, Kevin, is if you're going to go the route of buying options, understand the importance of the timing component. It kind of goes against the grain, but the best time to buy those puts is into that strength. Okay? You want to buy that put when it's getting as cheap as possible. So always remember, guys, we're playing two games here. We're trading the equities, we're trading the indexes, but we're doing it through options. So the best time to buy that at the money put is after your 3 to 4 day rally, right? Where those puts basically just get crushed. The implied volatility drops, all that premium gets just totally sucked out of the option. That's why I'm so hell-bent on trying to short on bounces into the 21. If you can get that strong bounce into the 21, now you're buying those puts that have gotten cheaper. If you want to sell a call credit spread, that 2 to 3 day bounce makes those calls nice and pricey. Right? So we just get better entries in our favor as far as options pricing goes when we sell or short into the pop, just like when we're buying the dip. So to minimize some of that nastiness that buying a put can bring to the table, really look to do that into strength. Buy that put when it's getting beat up pretty good. Hopefully that makes sense, Kevin. It's the only thing you got to be mindful of. Structure can continue to hold just fine, but you're fighting the clock. You're fighting the clock. So the best way to kind of minimize that is to try to buy that at the money put. After that at the money put has gotten beat up for the last 2 to 3 days. That's where you get that ideal timing. But all right, y'all, my lovely fiance has got some, I don't know what she's cooking up, but it smells good. So I'm going to go grab some dinner here, guys. The futures open up in 10 seconds. So let's at least hang around for the futures to open. And here I was telling you this would only be about 15, 20 minutes. Funny how that happens. Always a good time, guys. All right, but the futures are open. Your S&P 500 down 1/3%. Your QQQ down 1/4%. We're bleeding, people. We're bleeding. The small caps down 0.6%. And the Dow Jones down 1/3. But of course, we've got a long way to go between now and tomorrow's open. But there's your level, my friends. Big Dow Jones, the January 24th low. The S&P 500, January 24th low. And the Qs in the IWM. We've got our big picture context. Monthly charts are losing momentum. They're losing structure, bearish weekly squeezes. We got our bigger picture context. In terms of trying to accurately gauge where do we go tomorrow, next few days, my thinking is a lot of that will be dependent on where we are in relation to the January 24th low. So we'll see how it all unfolds tonight, guys. Always a pleasure, though. Always a good time. So y'all enjoy your night. Unwind a little bit. These charts tend to get a lot of our time and energy. So go pet your dog. Go spend some time with the family. Keep an eye on these futures. But good stuff, y'all. I'll see you tomorrow.